Hey there, Scott Groves with another mortgage mystery. This is going to be probably the longest video we've done yet in the mortgage mystery series, and I'm filming at my desk instead of in front of a green screen because I've got to do some math and I've got to work some numbers. When it comes to adjustable rate mortgages and interest-only mortgages. Now, there's a lot of confusions about what a adjustable rate mortgage is, how it functions, how you qualify for it. And there's also some things about it that are pretty counterintuitive. And so first, let's start with some definitions, right? Adjustable rate mortgage, fixed rate mortgage, and interest only mortgage. Now, a fixed rate mortgage is simply that. You take out a loan for $1 million. Let's say your rate is 5.5% because we're filming this in early 2022 and rates have gone up basically every day since Christmas and look like they're going to continue to go up. So unlike the videos we were filming a year ago where we were talking about rates in the 2, 3, 3.5% range, let's just say potentially rates are going to look like something like 5 or 5.5. So we'll use a 5.5% interest rate as our placeholder for a 30-year fixed mortgage. Doesn't mean that's what interest rates are at the time that you watch this video, but that's just kind of what we'll use for our mathematical equation, right? So let's say you're getting $1 million at 5.5% on a 30-year fixed term. Now, we just simply throw that into our calculator, loan amount $1 million, 30-year term, 5.5 interest. Your principal and interest payment is going to be $5,677 and some change. So basically, $5,700 is your principal and interest payment. Now, of course, there's taxes, insurance, maintenance, things of that nature on top of that loan payment. But let's just compare apples to apples. Let's just talk about the loan payment. So again, your 30-year fixed payment at 5.5%, and I should probably write this down because I'm going to forget some of this, is at $5,700. Okay. So one of the things that you might be looking into or you might be getting some advice on is, hey, why don't you take out an adjustable rate mortgage? Now, going back to 2008, 2009, when Hillary Clinton famously called adjustable rate mortgages liar loans, there was a segment of loans called negative amortization loans. We won't even go into what those were, but let's just say they didn't work out so well for consumers. And there were stated income loans, which worked out for many consumers, but the 10% of consumers that defaulted on their stated income loan is basically what threw the world into turmoil and created a worldwide recession back in 2007, 8, and 9 because of the 10% or so of stated income loans that went horribly bad. And so the overall idea of anything other than a 30-year fixed mortgage was really vilified, and I think improperly so. And now a lot of people are scared about getting an adjustable rate mortgage. But an adjustable rate mortgage does not mean that your payment will adjust every month that you have the loan. So most adjustable rate mortgages are classified as a 3-1, a 5-1, a 7-1, or even a 10-1. And what that means, very simply, the first number represents the number of years that the loan, the interest rate on the loan, will be fixed. So for example, if you do a 3-1, that means for the first 3 years of home ownership, your loan will look like, function like, feel like a 30-year fixed because you have a fixed interest rate, a fixed payment, a fixed amount going towards principal and interest, and nothing can change. Same thing on a 5-year, that fixed period is 5 years, 7-year, 10-year. So if you do a 10-1 ARM, we, the lender, have to explain to you that yes, 10 years in the future, this payment could become adjustable and it could adjust from year to year. 10-1, meaning fixed for 10 years, and then 1, it will adjust, the payment will adjust once per year after that, right? So a 10-1 simply means fixed for 10 years, looks like a duck, smells like a duck, walks like a duck. It's basically a 30-year fixed for that first 10 years. And then after that, it can adjust once per year for the life of the loan. But here's the thing, especially in the areas which I service, which is mostly, Southern California, Las Vegas, Nevada, Austin, Texas, kind of booming areas of Florida, the average homeowner in that area only stays in their house for about 7 years. And because rates ebb and flow up and down, most people only keep their mortgage for about 4 to 5 years because they either sell, they refinance, they pay it off, something happens, they pay it down, they get a new mortgage. So when people get scared about adjustable rate mortgages, usually they will never see the adjustment period prior to selling the house, paying off the loan, or refinancing, right? So I'm trying to talk for the last 20 years to clients into like, hey, adjustable rate mortgages are not bad. You can take one because you're not going to be in the house for 7 years. You're not going to be in the house for 10 years. So what's the advantage, right? So the advantage is if the lender knows that they're not having to fix in this debt for 30 years, especially right now as interest rates are going up, they're thinking about, well, okay, we can offer a lower interest rate if the client's willing to take an adjustability at some point in the future. So let's say, for example, our 30-year fixed rate today is at 5.5%. A lender might be offering a 7-year ARM, so fixed for 7 years, then adjustable once per year after that, at let's say 4.25%, 4.25. So if we plug that into our calculator, the monthly payment on that same $1 million loan goes to $4,920. So because the consumer is willing to take on some risk of future adjustments, which frankly they're probably never going to get to because they're either going to sell the house or refinance the loans, or rates are going to drop, or they're going to pay it down, for taking the risk of that future adjustment period, which again isn't going to happen for 5 years or 7 years or 10 years. This is all defined in your loan paperwork. They're going to save the spread between that $5,700 payment on a 30-year fixed and $4,900 payment on the 7-year ARM, which we were using for our example here. And that ends up saving you $780 a month, right? Over 12 months times 7 years. The consumer, if they do keep that loan, they're going to save over $65,000 in interest over that 7 years. So even if in 7 years from now, when property prices are presumably higher, maybe rates are lower or a little bit higher, presumably you're going to be making more money in 7 years, that $65,000 in savings over the next 7 years on this example on $1 million loan makes sense to take the additional risk of the 7-year ARM. And again, I want to make sure that we're clear that the adjustable, in the term adjustable rate mortgage, does not happen until a predetermined amount of time passes between when you get the home and that 3-year, 5-year, 7-year, 10-year period that you're going to know about up front. So there's no surprises. These aren't like the loans people were getting, the negative amortization loans that adjusted month to month, where people would wake up one day and be like, oh my goodness, I owe more on the house than what it's worth, or I haven't even been paying down the interest. Nothing like that can occur in this case because the loans that we've been talking about, the adjustable rate mortgages, are fixed where you're paying towards principal and interest. You're just getting a lower interest rate because at some point in the future, you're accepting the risk of the volatility of where interest rates are. And if the bank knows you're taking that risk, they'll give you a lower interest rate today. Now, there's another caveat on top of adjustable rate mortgages. You can have an adjustable rate mortgage that doesn't adjust for, we'll stick with this 7-year period. So it's a 7-1 ARM, meaning you have a 7-year fixed period on your mortgage. It will adjust once per year after that 7th year. You can also get a rider, which is called an interest-only rider, which means during that first 7 years of home ownership, you don't want to pay anything towards the principal, right? Maybe you want to come up, maybe you have a scenario where you're like, hey, I know I'm going to leave this house within 7 years, or I'm going to refinance, or I'm going to inherit some money and pay off the loan. I just want to keep my cost of owning this house as low as possible and basically rent the house from myself. So I know I'm making the strategic decision to put an interest-only rider onto this mortgage so that every month for the next 7 years, I only have to pay interest. Now, to be clear, 7 years from now, if you haven't paid off any of the principal and the rate can adjust, and you have to now pay principal and interest after that first 7-year interest-only period, that can be a little scary, right? Because now you're looking 7 years down the pipe. It's like, well, I either need to be comfortable with my payment going up dramatically because the rate could adjust, and you're going from interest only for the first 7 years to a fully amortized principal and interest loan that has to be paid off over the remaining 23 years. So you need to be mentally prepared for a payment going up dramatically in 7 years, or refinancing into some other product, paying off the house or selling the house. But just sticking with this example of $1 million loan, let's say you took the $1 million loan, You took the 7-year ARM, because all interest-only options accompany an adjustable rate mortgage. You can't get a 30-year fixed mortgage with an interest-only rider, because then it wouldn't be a 30-year fixed. It would just be an interest-only loan. Okay, so let's go to the math on the same $1 million loan. $1 million loan, 7-year ARM, which is 4.25%. They add about 1/4% for you taking the interest-only option. So we simply take $1 million, we're doing a simple interest calculation, times 4.5%, divide by 360 days, and then you're normally calculated at 30 days in a month. So 1 million times 4.5%, divide by 360, that's $125 a day of interest, times 30. So your payment goes to $3,750. So let's break down this comparison again. On the 30-year fixed at 5.5, you're paying about $5,700. At the 7-year ARM at 4.25, you're paying about $4,900. And on the interest only, again, you're just effectively renting the house from yourself, you're paying $3,750. So on $1 million loan, you can see where, dependent on your income structure, your comfort on the monthly payment, you can have a payment on the same purchase with a spread of about $2,000 up or down on the mortgage payment amount. Now, here's where we get into some confusion. People will frequently say, well, I wanted to buy this house and I need $1 million loan, but it doesn't look like I qualify at the 30-year fixed payment of 5.5% in our hypothetical situation. Scott, just give me a 7-year ARM or give me an interest only, because if the payment's, $700 or $2,000 cheaper, then I can easily qualify for that house and that purchase. Herein lies the problem, and herein lies some of my frustration with the advertisements in our industry. When a lender or an underwriter or an investor qualifies you for an interest-only product or a 7-year ARM, sometimes you'll qualify for less. And here's the reason. It's in the underwriting guidelines. Let's say, for example, the 30-year fix, we'll stick with this hypothetical, on $1 million loan is 5.5%. And the 7-year ARM is at 4.25%. Seems pretty straightforward, right? Except for the fact that the lender has to take into account that you might keep this loan past the 7 years, past the point where it becomes adjustable, and rates might go up in the future. So most underwriting guidelines on these ARM products, ARMs, adjustable rate mortgages, or the interest onlys, the IOs, they are going to take your start rate. In our example here, the 7-1 ARM on the $1 million loan was at 4.25%. And they're going to qualify you as if the interest rate was 2% higher. Because remember, even though we think you probably won't have this loan or this house in 7 years, you might have this loan in 7 years, and the interest rate might go up dramatically. So what they'll do is, for qualifying purposes only, and you'll see this in your paperwork, it won't be the payment that's actually due to the lender, but you'll see this in your paperwork. They'll take, in this example, 4.25 on the 7-year ARM. They'll add 2%. So now your qualifying ratios, your underwriting, your ability to buy the house is calculated at 6.25% interest rate, even though the lender knows it would be a worst case scenario 7 or 8 years from now before that interest rate was actually calculated on the debt that you owe. But they have to basically plan for the worst case scenario. So now you take that same 6.25% interest rate, 30-year term, sticking with our $1 million loan, and your payment goes up to $1 million loan, 30-year term, 6.25%. Your payment, actually, your projected payment, your qualifying payment, goes to $6,157. So the qualifying payment on a 7-year ARM actually gives you a higher payment than the 30-year fixed. And again, I want to be sure that you understand, on the 7-year ARM, you are getting the lower interest rate payment and the lower interest rate at today's market. But the lender, when they're going through your loan qualifications, they have to know what the payment could be. So I hate when lenders advertise like, hey, we're maximizing affordability, or we're getting people into houses that are more expensive than they thought they could afford by doing a 7-year ARM or doing an interest only. That's not the case at all, because the guidelines, the underwriting guidelines to get a 7-year ARM in interest only, one of these kind of more exotic programs, the guidelines are actually harder to qualify than a 30-year fixed. They require more reserve assets being money you have left over after your down payment to help weather the storm of a job loss or some type of unforeseen economic event, right? So the guidelines for a 7-year ARM, a 10-year ARM, an interest-only type product are actually more aggressive and more challenging, to where you really need to be a little bit better credit score, a little bit better with your reserves and your cash emergency accounts, a little bit more financially savvy, and frankly, you have to be making a little bit more money to take advantage of one of these type of products. So it's a great loan for the right kind of client. An adjustable rate mortgage, an interest only mortgage, phenomenal product for the right kind of client. And let me give you an example. I work here in Los Angeles, so I have a lot of clients that work in the entertainment industry. And maybe the TV show they're on or the shooting schedule that they're on tends to backload a lot of their income into the last half of the year, right? Maybe they work on a television show that films in the second half of the year, or they tend to get movie gigs over the summer when they can work in certain geographical areas. So overall, their income on a yearly basis might qualify them for one of these adjustable rate mortgages or interest only mortgages. However, although they show the overall total annual income to qualify, maybe on a month-to-month basis, things are a little bit tight because there's months where they're not working or they're in between shows and they'd like to have that lower monthly payment. This is a perfect product for somebody in that high earners but variable income scenario to take advantage of a product like this, get the lower interest rate, know that there's a plan 3, 5, 7, 10 years from now to refinance, to keep an eye on maybe the market coming down and the 30-year fixed mortgage being low enough to where it makes sense to take advantage of that refinance. But again, a great product that's totally misunderstood and completely misadvertised. I think I made that word up, but that's okay. So if you are somebody who's looking to get an adjustable rate mortgage in interest only, if you're kind of a high net worth earner, right? Or you have high net worth or you're a high earner, but you'd like to keep your monthly expenses way down. Or if you're a realtor that would like to have this kind of explanation to your client, then get in touch with us. Our team is licensed in about 7 different states. We've got referral sources in all 50 states. So if you're looking to do one of these jumbo loans, an adjustable rate mortgage, interest only, and your loan officer can't quite explain it to you or can't quite help you break down the math or can't get you qualified because they don't understand some of the stuff that we went through, get in touch with us. Scott Groves and Dallas Skinner, we're here for you, and we'd love to help you get into a home. Talk soon. Calendly link, email, phone number, everything is below. Talk soon.